$124,500. Just a few days ago, Bitcoin didn't just break its old record, it shattered it. The headlines are everywhere, the charts are vertical, and the crypto news cycle is in a frenzy. But the most important part of this story isn't the price on your screen, it's the price of the house down your street. By the end of this video, you will understand the hidden economic connection between the new Bitcoin all-time high and the real-world cost of living, and the theory behind why this rally is fundamentally different from anything we've seen before. This isn't just another crypto bubble story, this is a story about the rewiring of our financial system. So, how did we get here? A price surge this massive isn't random. It's the result of a perfect storm, a convergence of three powerful forces that created the ideal conditions for this historic rally. The first force is the macroeconomic tailwind. To understand this, you need to know two acronyms: the Fed and CPI. The Fed, or the Federal Reserve, is the central bank of the United States. When they want to cool down the economy and fight inflation, they raise interest rates. This makes borrowing money more expensive and encourages saving. But when they want to stimulate the economy, they cut rates. Lower rates make saving less attractive and push investors to seek higher returns in assets that carry more risk, like stocks, and especially like Bitcoin. For months, the market has been watching the CPI, or Consumer Price Index, which measures inflation. Recent data showed that US CPI came in softer than expected, at 2.7% year over year. This was a huge signal to the market that inflation was cooling, giving the Fed a green light to consider cutting rates. In fact, financial tools like the CME FedWatch, which tracks the probability of rate changes, showed a staggering 93.7% chance of a rate cut in September. For big money investors, that's as close to a sure thing as you can get. This widespread expectation of cheaper money created a massive appetite for risk, and Bitcoin was a primary beneficiary. But this rally is about more than just cheap money. The second, and perhaps most important force, is the Wall Street stampede. Previous Bitcoin rallies were largely driven by retail investors, everyday people buying on apps fueled by hype and FOMO. That's not what's happening in 2025. This time, the institutions are here. The game changed with the approval of spot Bitcoin ETFs, or exchange-traded funds. These are financial products that allow massive institutions, like pension funds and asset managers, to get exposure to Bitcoin without the complexity of buying and holding the asset directly. The floodgates opened. In just the past month, these Bitcoin ETFs have seen inflows of over $3.6 billion. This isn't speculative hot money, it's strategic, long-term capital. These institutions view Bitcoin as a legitimate asset class, a potential hedge against inflation due to its fixed supply of 21 million coins, and a way to diversify their massive portfolios because its price doesn't always move in sync with stocks and bonds. The scale of this is hard to overstate. Today, corporate and sovereign treasuries now hold 3.64 million BTC, which is over 17% of the total supply. This strong structural demand, as analysts call it, creates a much more stable foundation for the price. When institutions with trillions of dollars under management are buying, it signals a fundamental shift in how the financial world views Bitcoin. This institutional confidence wouldn't be possible without the third and final force: the Washington green light. For years, the biggest barrier to institutional adoption of crypto was regulatory uncertainty. Big firms were hesitant to invest billions into an asset class that could be regulated out of existence overnight. But in 2025, that uncertainty has dramatically decreased in the United States. The current administration has taken a distinctly more crypto-friendly stance, signaling an end to the previous regulation by enforcement approach. We've seen moves to ease crypto investment within 401k retirement accounts, and the appointment of a new, more supportive SEC chairman. This regulatory clarity is the final piece of the puzzle. It gave large conservative institutions the confidence they needed to enter the market. So you have a perfect storm: the promise of cheaper money from the Fed, a tidal wave of institutional capital, and a clear regulatory runway from Washington. Together, these three forces propelled Bitcoin to its new all-time high. But the story doesn't end there. In fact, this is where it gets truly interesting and where it starts to affect your life. even if you've never owned a single fraction of a Bitcoin. When a stock you own goes up, you might feel a little richer. But what if I told you that new academic research shows that for every dollar you gain in crypto, you're more than twice as likely to go out and spend it than if you gained it in the stock market? This phenomenon is called the crypto wealth effect, and it has massive spillover effects on the real economy. Groundbreaking research from the National Bureau of Economic Research, or NBER, has quantified this. They studied the spending habits of millions of households and looked at something called the marginal propensity to consume, or MPC. That's just a fancy term for, if you get an extra dollar, how much of it do you spend? What they found was stunning. The MPC out of unrealized crypto gains is about 8 cents. That means for every dollar their crypto portfolio goes up, the average person increases their spending by 8 cents. Now, that might not sound like much, but compare it to the stock market. The MPC out of stock market wealth is only about 3 cents. This means crypto wealth is far more potent. It translates into real-world spending more than twice as effectively as stock wealth. This table shows why crypto is so different. It acts like a hybrid between a cash windfall and a traditional investment. The gains feel more accessible, more real than paper gains in a retirement account, leading people to spend them more freely. And here is the critical connection, the one that delivers on the promise from the start of this video. The NBER research identified exactly where a huge chunk of this new spending goes: housing. The data shows that following crypto gains, households significantly increase their mortgage expenses and are more likely to transition from renting to owning a home. This creates a direct causal link. Bitcoin all-time high creates trillions of dollars in new wealth. A portion of that wealth is cashed out and used for down payments on houses. This sudden surge in demand for a limited supply of homes creates intense, localized bidding wars, pushing up prices for everyone. The effect is measurable. The research found that counties in the U.S. with higher levels of crypto ownership see their house prices grow about 46 basis points faster than other counties following a major crypto bull run. The BTC price on a screen in Tokyo is directly contributing to the sale price of a home in Austin, Texas. This is the crypto wealth effect in action, a powerful, invisible force connecting the digital asset world to the physical world we all live in. The consequences of this new Bitcoin all-time high extend far beyond the U.S. housing market. We are seeing a fundamental integration of crypto into the global financial system, which brings both opportunities and new systemic risks. For the first time, Bitcoin's price is moving in closer correlation with traditional markets like the S&P 500. This means crypto is no longer an isolated island. A major crash in the BTC price could now trigger sell-offs in the stock market, and vice versa. The financial health of the crypto market is now intertwined with the health of the entire global economy. This risk is amplified on corporate balance sheets. Publicly traded companies like MicroStrategy now hold vast amounts of Bitcoin as a treasury asset. This means their stock price is directly tied to the volatile crypto market. A sharp drop in Bitcoin's value could erase billions from their market capitalization, impacting investors who may not even realize they have indirect exposure to crypto. And of course, no neutral analysis would be complete without acknowledging the ongoing environmental debate. Bitcoin's proof-of-work mining process consumes a massive amount of energy, with a carbon footprint comparable to that of entire countries. While the industry is making strides in using renewable energy, this remains a significant concern for ESG-focused institutional investors and a key point of debate about the asset's long-term sustainability. Finally, the U.S.'s new pro-crypto stance is creating a geopolitical ripple effect. It's putting pressure on other economic powers like the European Union with its MiCAR framework to create clear and competitive regulations. We are witnessing the beginning of a global race to attract the trillions of dollars flowing into the digital asset economy. The actions taken in Washington are forcing the hands of regulators from London to Singapore, accelerating the creation of a global framework for this new asset class. So, what does this all mean? The 2025 Bitcoin all-time high is not just another speculative frenzy. It's the result of a powerful convergence of macroeconomic forces, a historic influx of institutional capital, and a pivotal shift in government regulation. Its consequences are more profound and far-reaching than ever before. Through the powerful crypto wealth effect, this digital event is having a tangible impact on the real economy, influencing everything from housing affordability to corporate stability. The future, of course, remains unwritten. The market is still incredibly volatile. Debates rage on about whether we are seeing the peak of an altcoin mania that could trigger a sell-off, or if this is just the beginning of a much larger Godzilla rally for Bitcoin. This analysis is purely theoretical, designed to help you understand the forces at play. It is not financial advice. But one thing is clear. Bitcoin and the digital asset economy are no longer a niche corner of the financial world. They are a major, integrated part of it, and understanding the deep economic theories behind the headlines has never been more important. This is a complex story with huge implications. What part of this analysis surprised you the most? Was it the direct link to house prices or the sheer amount of Wall Street money now in the game? Let me know your thoughts in the comments below. Your perspective helps everyone in this community learn and see the bigger picture. And if you want to stay ahead of the curve and understand the deep economic theories behind the headlines, make sure you subscribe and hit that notification bell. We frequently break down complex topics like this, and you don't want to miss the next big story. Thanks for watching.